It's not super sexy to have a 5% cash on cash return. Early retirement, financial freedom, $300 a month. I need 10 houses or 20 houses, but they don't think about the wealth you grow over time. People build generational wealth. It's everyone runs out of money eventually to use as down payments. More you can use creative finance to acquire. It's about ownership of quality assets in good locations with good teams.
Appreciate the hell out of you jumping on. Who are you? What do you do? All that good stuff.
So our company, just making sure the mic's good here. So you can hear me good, yeah?
Yes, sir.
Okay, so our company, Rent to Retirement, turnkey provider, mainly focusing on build to rent. So we've been in business for about the past decade. We do about 800 to 900 transactions a year where we mainly single family, small multifamily, where essentially we build, lease, and manage those properties for our investor community. My background, I have a background in healthcare, optometrist by education, same with my wife, Air Force captain for 7 years. Went through that, started investing, house hacking, doing all the things, started investing in real estate, bought my way out of the healthcare world, found there was a lot of interest in people to passively invest in real estate or semi-passively, where they access different markets across the country, don't have to build their own teams, and those kind of the people that we service. My personal portfolio, what we mainly invest in, so mainly investor wise on rent to retirement, single family, small multi, that's a really good starting point. Usually our clients are like high net worth investors just getting started in real estate or want to be more hands off. I do a lot in the commercial retail center. I'm in Denver, and so we have a lot of centers out here. We do luxury short-term rentals. We have the highest grossing properties in actually all of Colorado, and those are in the mountains, Keystone and Breckenridge. So do really well with those, and that's about me in a nutshell.
Badass. That's one of the best elevator pitches I've heard. Good 3-minute resume. You do a lot. So you do single family, you do small multi, and you do commercial. Did I get that right?
On our personal side, yes. Our core business which is usually what we end up talking about for the most part, or I'm happy to go whatever direction you want to, but our core business, rent to retirement, we build or renovate single family mainly, and also small multifamily, so 1 to 4 units. So
How'd you get into building? Did you just hate like rehabbing old ass houses or what?
actually what I hated dealing with was the clients long term, where you can rehab a 19th house in Ohio or wherever, and it does great for the first 1 to 2 years, and then things start to fall apart. People are upset. They want to invest in a passive property, not have to deal with issues post closing. And honestly, new construction, and we build our own, and we also partner with national builders like DR Horton to sell their inventory to our clients. It's more predictable, and I think this is a better investment long term, and especially in growth areas where people tend to build. So
Do you think it's cheaper? Like overall?
long term, it's not cheaper up front, and that's the caveat, because you can buy a $150,000 house that has a 12% cash on cash return and whatever, leverage 20% down, and be into it for less money and actually look at better returns year one. But yeah, probably from an ownership standpoint long term, and I don't know if you're referring to the building side or selling to an investor, but yeah, I think there's less capex and less maintenance over that first 10-year period, and new construction certainly appreciates better, both in rents and in home prices. So it may be more expensive to buy initially, because our average new construction home is 300,000, give or take. But over the long term, I think it performs better.
I would say also maybe in a highly appreciating area.
Yeah, that you get the equity that's when you really talk about building wealth in real estate. You look at cash flow initially, but it's the growth, it's appreciation. So that's all of the building we do is Sun Belt. Florida, Texas, Alabama, Carolinas. That's the main areas we focus on.
I wanted to bring that up too, because like for years, I would find the cheapest ass properties, put some lipstick on them, and get badass rent. Built a whole like low income housing portfolio doing that, and it's great. But I've got a mentor, and he says if it's high cash flow, there's a reason. And I never stuck. And then I was like, damn, that you got to just know what you're into. So, like you said, you're getting a new product and you are building people's wealth. It might not be huge cash flow up front, but if it's in a good appreciating area and it's new, I'm getting more on that bandwagon.
Yeah, look, it's not super sexy to have a 5% cash on cash return, and people can't translate that. Newer investors, they think about cash flow, they think about early retirement, financial freedom, and they use that to extrapolate the cash flow. If I'm getting $300 a month, I need 10 houses or 20 houses, but they don't think about the wealth you grow over time. And actually, new construction, like our rents go up at 6% per year on average, new construction. That's double the national average. And so your cash flow will improve over time. But yes, you sell that property in year 5, 1031, exchange it up. And that's how you get that cash flow play over time. You shouldn't be thinking about trying to retire tomorrow, but maybe we should save some of this for the show.
Oh no, I'm recording. We're on the show, bro. I look to make sure there's a red dot up there. Dude, we're super like raw, unfiltered on this show, like just real. You know what I mean? That's what I like to do. I like to drop gems for people new, mid, experience, whatever. We've got all sorts of guests that come on here. And dude, no, I appreciate you coming on here. And the thing is, the reason I bring that up is I've got a buddy, he buys in Florida, and his appreciation has been like, and this sounds crazy. I almost feel like I'm lying, but he showed it to me on paper, has been $100,000 a year for the last 3 years. They're dupe. And like I was giving him crap about his cash flow. I was like, you're not making any money. And then now he shows me and I'm like, oh hell, like all the cash flow that I thought you should have made, like now you're just gonna crush it.
And yeah, that was going to be my next question is $100,000 of appreciation on what? Because if it was a large apartment building, that may not be much, but on duplexes, that's fantastic. And it all goes back to being in the right market where there's supply and demand. 101. You know what I mean? I think what really translated our wealth is my wife and I, when we were growing and being able to replace our income, was the fact where we, one, looked at different markets around the country where we saw, better growth and appreciation. We understood investing over a period of time. We weren't hyper focused on cash flow like we talked about. And then also coupling that with the tax benefits, especially over the past 5 years or since 2017 Tax Act, the simple fact of doing things like accelerated depreciation in your cost segregation studies or going through a 1031 exchange and being able to trade up. Those are the type of things where you can roll your equity and keep reinvesting your equity and how you get that compounding wealth and like really get to that high level financial freedom. We always talk about with our investors, initial financial freedom. Most people think about replacing your income or replacing your expenses. It's like replacing your active income. And then the next level is like generational wealth where you can actually change your lifestyle beyond what you initially had. I'm all about that for sure.
And that's hard to fathom for some people. Where did you learn that? Or do you have a badass CPA or resources?
I think that paying a lot of taxes is painful, and most people that want to invest their money also want to be conscious about the defensive side with actually saving taxes. That's if, for example, if you had, let's say, and we do this a lot with some of our high net worth investors that maybe they're a doctor. Nicole, did you have something on that?
Nicole, you got to go on mute. You're interrupting the show. Sorry.
Sorry, I thought I was on mute.
Okay. So like with some of I'll give you a practical example. So there was a dentist couple, both couples were dentists, making really good money, paying shit ton in taxes every year. Newer investors, they don't care about cash flow. They're not trying to retire tomorrow. Now, I'm not saying you want to be conscious about cash flow, but their big thing when we were working with them is how do I save the most amount of taxes I possibly can through real estate investing? We understand real estate investing has a lot of tax benefits, but just going through, and we built out a portfolio with them where they bought new construction houses. And I'll go through the numbers in a second, but they buy new construction houses. They did the accelerated depreciation. They were not real estate professionals, but we were able to teach them how to short-term rental. And this isn't our typical turnkey. When you think about turnkey, we do the management for you. But in their particular case, we had a cheat sheet on how they could self-manage for the first year. And so they could take their accelerated depreciation to offset their active income and then next year turn it over to management because they don't have to. They're going through the short-term loophole for accelerated depreciation. But we saved them over $500,000 in taxes that they would otherwise pay to Uncle Sam and never see again. But now they get to reinvest that money into other assets, and then they get this snowball effect. It just keeps happening. But on $1 million property, for anyone that's not gone through cost segregation or what that picture looks like, $1 million property, our studies usually come in around 30 to 34%. So call it $300,000 to $340,000 of bonus depreciation you can take year one. Now, if you're a real estate professional or you're doing the short-term route, you can take that against all sources of income. It's not just passive losses. And so you can create a significant loss. Now that's 100% bonus depreciation. This year we're at 60. If you have property you previously bought, it is retroactive to when you put it into service. So if you bought a property 3 years ago, you could, in theory, get 100% bonus depreciation on that as well. But if you think about it, if you buy $1 million worth of real estate, you could leverage and put 20% down if it's single family or 25 on multifamily to get a 30 or $300,000 to $350,000 tax deduction. That makes all the sense in the world to do, right? And so anyways, I could go on and on about that, but those are some of the things I think your question was, how do we learn that? It's just school of hard knocks, learning about taxes, having the right CPA that's financially literate in real estate. And that's an investor themselves. Everyone we hire is an investor themselves and understands real estate and is understanding our goals and what we want to accomplish.
I think that's huge. And you said you were able to do that even though they weren't real estate professionals. How'd y'all manage to do that? Because a lot of people think you've got to be that to get those benefits.
Yeah, there's two main ways: real estate professional status, and sparing everyone the details with that. Beyond, that's got to be your main source of income or the majority of your income, or your spouse. We have a lot of people that, hey, spouse is real estate professional, and that's the route to go there. But if it's just not possible, you're a new investor, spouse is working, you can self-manage your short-term rentals yourself. Those in the IRS, and I'm not a CPA or attorney, but we have very good ones. That is considered an active trader business. It's like hospitality. So if you're self-managing a short-term rental, there's no hour requirement for that. It just has to be that you're the only manager and you're spending more time than anyone else on it. You can accelerate the depreciation on that against all active income. Sometimes that's a route that people may go if they can't qualify for real estate professional. Whether or not, for us, it's like there's a new construction property that they want to be passive on, but they're choosing to be more active for that first year. And then for the tax benefits in the following year, you can turn it over to management and do whatever you want, because it's only about the year that you claim it, right? And it goes into service. So that'd be the route they go.
I had never thought about that, how you could get that if you're short term. I didn't even know that, to be honest with you. I've always just been one, but I've never. And for people listening that aren't real estate professionals, you get crazy ass benefits if you're a real estate professional. And he just gave this big ass hack: go get a short term rental. Talk to your CPA, of course.
It's huge, just based on those numbers as well. And so that's going back to the main point. I think that's how people build generational wealth. It's everyone runs out of money eventually to use as down payments. More, you can use creative finance to acquire. It's about ownership of quality assets in good locations with good teams, letting real estate do what it does over time and appreciate, go up in rent and increase the cash flow over time, but also being smart on the defensive side with the tax stuff. And there's no other asset that's more beneficial than real estate. It's just, so we love it.
You probably deal with wealthier clients, I would think, in your space, not newbies. And I'm just, the reason I say that is, and I could be wrong, but like a lot of newbies go for low hanging fruit. They go for the cheap and put the little and build, and then they get money and they go into the mid, and then they get good money and they start putting it in to preserve it in A class. Do you see that a lot, or who do you work with?
Yeah, there's a level of trading up. It's all about getting started and then trading up, and everyone has a starting point. We work with a lot of newer investors, but they do need, most of our clients, they have jobs, they're financeable, they're able to put down payments on properties. Usually with conventional financing, you need 20 to 25% down to buy a rental. And then if you're doing that, and you're likely to have positive cash flow and a good return on your investment, we play in the $150,000 to $300,000 space for a residential property. Yeah, you probably need $40,000 or $50,000 to put down on a property. You can be a newer investor. I think where turnkey appeals to people and build to rent is the investor that's new and just getting started and has money, and they want to make a smart investment and learn from someone and reduce the amount of obstacles and pitfalls they could have that could set them back. So it's a great way to actually learn from our team to build your confidence and just make a solid investment. People that live in expensive markets, their local markets are way too expensive or don't make sense to invest in. And then people that want to be more, no real estate is 100% passive, in my opinion, but it is a way for people to be more passive, where they like real estate. They don't want to buy themselves another job. We do have some people where if you have less than that capital amount, how can you be creative to still make an investment if it makes sense for you? There's some credit unions, for example, that we partner with where they'll lend multiple properties with 5% down. You still have to qualify for those. That is a non-conventional loan. It's a portfolio loan where they underwrite it in-house, but it's on true investment properties. We're not talking about trying to live in the house hack, things like that. Most people don't know that there's loan options where you can get 95% financing. Your cash flow may be limited, but they'll actually finance you on up to 5 investment properties. They're fixed rates it's a 10-year term, 30-year amortization, no prepayment penalty, no PMI, unlike conventional when you put less than 20% down. So that's a really long-winded answer to say we work with anyone that's interested to work with us, and being creative with them to help them find ways to invest if they have limited resources.
Yeah. And how did I was going to ask this earlier, but you're really passionate about this and you seem like you do really well and you're very knowledgeable at it. What made you see the need for this and just go after it?
So my wife and I, we come from a background in healthcare. I went in out of school. I went straight into the Air Force as a captain, practiced optometry for 7 years. We were interested in just being smart with our money. Investing. The first house I bought I house hacked it. I used a VA loan, no money down. Bought a duplex, lived in half, rented out the other half, and it solidified for me. And that was about 15 years ago, Travis. I always tell people from that point, I've never taken a year off from investing. Every single year I bought more property. I haven't made money on all those deals. There's been some sour ones, but I've continued to invest that entire time, because that's really what it takes to build a large portfolio. over time and really create financial independence. And in real estate, you can do that. Maybe not overnight, but in a short period of time, you can create a retirement picture if you're intentional. But there was a pivotal moment that really changed the trajectory of our lives. And that's when we learned how to invest out of state. I was stationed in North Dakota, not the most attractive investment market. It was okay. It cash flowed well. And once we were more intentional about actually buying in different markets, the first houses we bought out of state, we had a terrible experience with. We didn't know what we were doing.
I think I lost your volume there.
Uh-oh. You still got me? Hopefully you got.
Unless it's on my.
It's on your end.
Awesome. What I'm gonna do, because I lost your. Oh, I probably got you now. I didn't mean to cut you off. We're gonna go to Q&A if that's cool, because I think this West Texas service is about to nip me. Nicole, what you got?
Hey, how are you? Sorry about the noise earlier. I was just wondering, for me, I'm pretty new to investing and whatnot, and I seem to always have a problem with an accounting side of things. Like, where would you start off in finding a good accountant? How do you really go about analyzing who's actually good and who's just trying to get money from you?
Yeah, and that's a great question. I think that would apply to attorneys, to brokers, to lenders, really any professional that you're wanting to work with that is part of your dream team, which you certainly need as you're building your team and approaching this like a business. Specifically on the accounting side, I always ask an accountant and all these professionals, do you own real estate? That is a hard yes or no for me, because if they do, they understand it. You would think that an accountant would be sophisticated in all things accounting related to real estate, but some of them aren't. So I would maybe at REIA groups or part of these networks, things like this, you can ask around for references for people that have good accountants. But I would always ask, make sure they invest in real estate and make sure they're very clear about your goals, what you're ultimately trying to accomplish. The other mistake people make on the accounting side, I think sometimes, is looking to their accountant to give them a whole tax strategy and plan and tell them what to do. And that's not really fair to accountants, because they're trained to be defensive, where you give them what you're doing and they run the numbers for you and file your taxes. But there are businesses out there that are tax strategists, and sometimes those are accountants as well. And then there's accountants. So tax strategists are like your offense, who gives you the plan and strategy that you need to have some influence on as well. And then there's your CPAs and your accountants that file taxes for you. But first, I would ask for references from people that are already in real estate. I would ask the accountant if they're an investor themselves, and maybe just quiz them a little bit on what kind of things they're doing. And they should be able to talk to your situation a little bit.
Thank you.
JP, what you got?
Yeah, hey, appreciate you coming on. My question is a little more obscure. So you talked about partnering with builders a little bit earlier. How'd you get started partnering with some builders? I'm looking at doing some land plays out here in Florida. We're starting to partner with some smaller builders, et cetera. But when you talk about some of the bigger builders, they got a lot of their teams built out, et cetera. Did you just bring your business model to them, and it was just entirely new for them, new avenue for them to invest in or get rid of some properties? Or how did you start going after the builders to partner with?
I'll say that the first thing that we did many years ago, and we had a terrible experience with builders. We lost millions of dollars with working with the wrong builders. And these were usually regional builders that were very small. They weren't in business for a long time. Those are the people that we were doing personally spec builds with. And that was a terrible experience. We're still dealing with some of those, and we're building in South. I don't know where you're at in Florida, but we're building, and still 4 years later, many houses in Southwest Florida, like Cape Coral and in that area. I would say if you're looking to partner with builders, you may have to start there with the lower guys, the regional guys. Make sure they're in business for multiple years. You check references, you check timelines. But the lower builders, it's not that hard to become a builder these days, especially in Florida, man. Like, construction is like the number one industry, and there's a lot of builders going under right now. So it's a volatile space. How we got into working with larger builders is bringing more volume, and that wasn't an open door to begin with, but what we offer them is a disposition channel to sell hundreds of houses. So for an example, we have a partnership with LGI and DR Horton, some of these largest national builders, where they're sitting on inventory right now. They're sitting on hundreds of houses that the retail market, because that's their main disposition, is selling retail. There's so much volume that we have hundreds of thousands of community members in our community that are looking for those from an investment perspective, and just being able to talk to their institutional teams and their wholesale teams instead of the retail teams to show them how we can help them move some of their investments and make really good investments for our investors is how we open the door to those investors. And because of that, we were able to offer products for people at like 10 to 20% below market value that John Doe would not get access to from DR Horton just walking off the street. but because they're a part of a larger community, we're able to negotiate better deals and create value for both sides, for the client as well.
Awesome.
Man, Zach, thank you so much for coming on. Appreciate the heck out of you. Where can people find you?
Always want to drive traffic to our website. That's renttoretirement.com, renttoretirement.com. If you're in the car doing deals like Travis is right now and you want to text us, you can text REI to 33777. And yeah, we'd be happy to talk with anyone that's interested about investing out of state, turnkey, build to rent, any of the above.
Hell yeah. Great meeting you, brother. Have a good rest of your evening and keep kicking ass, dude. Love seeing it.
Hey, thank you. Thanks for having me on.
Later, bud.